Okay, good afternoon, everybody. Today is May 5th. It's Friday, about 1:05 Pacific time. Market just closed. Your weekly take on the market. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD is licensed. We don't make buy, sell, hold recommendations. Our sweet spot, our circle of competence is education, research, etc. Okay, great. So we'll do the same stuff. It's been a couple of weeks. I didn't do one last week since we had our Thursday event on the markets. So I have a few slides from the weeks, a couple of weeks here that I've accumulated. And then we'll do the industry groups, stocks to watch, quarter of the week. You know the drill, right? No surprise, the market's very, very narrow. I think everybody sees that. So the number or the percentage of stocks outperforming the index 20-day average is as low as it's ever been since 2000 from Sentiment Trader. So there's not a lot of stuff to buy. Like the markets seem fine, but the unfortunate part is if you're looking to buy individual stocks, there's just not a lot of merchandise. There are a few names, but it's not very broad. And this has to absolve itself. I don't know which way. Is it going to absolve itself like the 2000 top where the indexes just can't take the pressure anymore and they roll over? That's it's kind of the normal game plan for the market, but that's based on history. I know in 1987 people talked about how thin or how narrow is the right word I was looking for. Narrow the market was getting on the way up. So the number of the sample size is very small. I don't know how it's going to absolve itself or resolve itself. It is what it is. You should be aware of this, and I think most of us are. Another problem, so to speak, with the market is how top-heavy it is. Here's the weight of the S&P 500. If you take Apple and Microsoft combined, they make up 14% of the index, and that's been a problem for a while. So from 2018 on, it looks pretty parabolic, and it hasn't changed that fact. So it's becoming, there's the old saying, it's a stock market or a market of stocks, and it's a market of stocks that are holding up the stock market. Apple, Microsoft, Nvidia, what else? Even Google and Tesla, they're just okay, but it's just these big cap stocks that are getting all the money. They're especially in the tech area, and they're considered sort of safe, especially with this whole banking thing that's going on. So again, I don't know how it resolves itself. Based on history, it resolves itself to the downside, but the problem with that is I feel like everybody knows that, and there's just a lot of caution out there, a lot of negativity. I see very few people. We're talking to my colleagues about the market environment, and every Substack I get, every tweet, every podcast title is cautionary to negative. I think there's maybe a couple of people that I follow that are pretty bullish, but it's most of it is caution, and it's the logical place right now is to be cautious because everything that you see and hear and feel tells you that you should be cautious, and that's not a great way to invest. So it could be already built into the price in the market, which is why today the market had such a really strong day, because the banks didn't go down today, and Apple's numbers weren't terrible. And that's all it takes for a stock like Apple to go up 3.5% or whatever the number it was that it did, because they just weren't terrible. And so it's all about positioning and sentiment and how everybody is set up And if they all get on one side of the boat, the boat tends to tip over. Day-to-day volatility is pretty crazy. I think we all see that. The 0 DTE, which stands for 0 days to expiration options in the S&P, as a total volume of options. Look at the number of how big that's become. So there's a lot of people trading, investing, gambling, whatever, speculating, whatever the word you want to use, in these 0 days to expiration. They expire in 6.5 hours or less. Each day is its own ecosystem is the title. I really like that. The market, I don't remember who it was that coined the phrase. It might have been Doug Cass, but the market has no memory. And it's very true. Each day, the market doesn't remember what the previous day was like. And we do. So if it's a bad day, we kind of remember that and expect another bad day. If it's a good day, we remember that and expect another good day. And the market just comes in every day, like it's been been rebooted and starts from scratch. And that's why you get these poor closes and great days the next day, and great closes and poor days the next. It makes it pretty hard to position for sure. Margin debt is coming down while the market is holding up. You can see how normally they move in sync. You do need some margin out there to kind of push the market. And there's a little bifurcation between these two. So we'll see. We'll see if people start feeling like speculating again. We would need some of that fuel on the fire to really push stocks. And then last but not least, I think it's last but not least, sentiment. Just week after week after week where you have more bears than bulls. There's a lot to be said about this poll. I don't think the sample size is very large. I don't remember exactly how many it is, but I think it's very small, like 100 or less. But it's individual investors. This is the AAII sentiment. I apologize, I forgot the header. But just bearish, 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 and it's easy to be bearish right now, which makes me nervous on the bear side, because it just looks too easy. Banks are going out of business every other week, and it just seems too easy to be bearish, and so that has me a little cautious on the bearish camp, because I will go short and will play the short side, and so I have to think about the other way. And if I feel like it's just getting too easy on the short side, I have to pull back. I think yesterday, I'll pull up the chart. Somebody tweeted that the short interest in KRE, which is the let's go to that. Let me resume my share, make sure I don't mess this up. KRE, which is the regional banking ETF, there it's like painfully obvious it's going down, right? PacWest try to put themselves up for sale, and somebody tweeted that Bloomberg said that the short interest on the regional banks was 93%. So in other words, almost every single share out there was sold short. When I saw that, I just said, run for the hills. Whether that's right or wrong, it doesn't matter. If people see that, the big money sees that, they will probably act. And so I had a couple of banks that I think are, they look like they're going down a lot to zero maybe, and I just reluctantly covered them. And just today was just crazy in this area. PacWest was up 81% today. WAL was up 50%, and MCB was up, oh wow, real underperformer, 15%. So if I feel like going back to this area, this would be the one I would choose. Let's go back to the indexes. So here's the NASDAQ, and it looks fine. Now, what's the price? 12,235. Let's play a little game. Let's draw a little red line across. And you can see, going back to, imagine you were just buying the NASDAQ, regardless of what happened. And let's say you you bought the NASDAQ 401k money on April 26th of 2022. So here you are, more than a year later, you've gone nowhere. And I think it's even worse for the S&P. We go to the S&P. I guess it's sort of the same, April 26th or something. But how about if I go to a monthly? So let's say you know what, we're in this massive bull market, and you just capitulate and say, I better buy stocks. And so you buy in the month of April of 2021, and you do get a little dividend or something, but basically the market's gone nowhere for over a year. And that's really kind of what's going on. It's just a really sloppy, choppy. You do have a series of higher lows, possibly, but there's just no umph to the upside and no umph to the downside either. So this looks like it should go lower, it goes lower for half a day. This looks like it should go lower, it goes lower for 1 day, and then the next 2 days you get your face ripped off if you're short. And this looks like it should go lower, and today you come in and get your face ripped off if you're short. It's really, really difficult. So I don't have a lot of exposure to the long side. I've got very, very little exposure to the short side. I'm just waiting for it. I think I would be more long if there were more setups, but maybe if there were more setups, it'd be too obvious and the market wouldn't work. So you get the idea. But there's not a lot of setups. There's just not a lot for me to get excited about. But I do have a lot more long exposure than short exposure. But it's I'm not over 100% by any means. I'm not on margin on the long side. Gold is holding up okay. I tried to go down a little bit today, not too bad. Silver building this huge base, and I keep waiting for these to break down, because normally this is right when gold breaks down. So it went up for 1, 2, 3 weeks and then gave 80% of it back, looked like it was going to keep going, and then end up giving it all back. And that's kind of the MO of gold. But AGI this sure looks pretty good. Nice breakout, very orderly pullback. I have a little bit of FOMO on this one. Like I did own this one, and this morning I saw it was down. I was like, good, go down. It couldn't go down. So it's interesting to me. I think the guest on IBD Live said he owned a lot of gold stocks. My experience with gold stocks is when they look the best, that's when they're the worst. So I'm a little reluctant here, but maybe that will finally change. But this one and OR, I think it's OR is a ticker. Yeah, these ones are on my radar. Sorry, I've kind of sort of swiveled into stocks, right? But that's because I had gold on the brain. And then I guess we should look at the bond market, because the bond market, the Fed, is on everybody's radar, and it's just super, super tight. Look at the TLT, just like really, really tight, like nothing going on. Let me change the scale on this. But you've got, look at that. So you've got 5 weeks tight in there, 4 weeks tight in there, 3 weeks tight in there. So it's gonna do. I think there's something could play out, and problem is, if you're buying bonds, like let's say the bonds break out to the upside, that means the yields go down. Normally your first instinct would be bullish the market, but what if there's a reason like something's broken and that's why yields are breaking out? So it's a little counterintuitive. And then maybe if yields start going up, and the stocks could go higher. It's possible, because maybe they're going up because the economy is so good. Where's this recession that everybody's been predicting? So I do watch bonds. I do kind of keep one eye on them, but I don't know. I buy bonds, but I don't trade bonds, if that makes sense. So anytime I buy a bond, I just let it mature. I never sell it. And I'm not I buy very short 3, 6, 9, 12-month ones. And I don't even look at them, just let them mature. All right, so let's jump to, I think that's it for the indexes. Let's jump to the industry groups. Oh, bank super regional, worse. What a surprise. So building residential is number one. Let's make this bigger. And again, kind of counterintuitive, all the reasons in the world that home building stocks should be going down. Not only they're not going down, number one, growth, right? Which is why we use charts, why we let the market speak to us, because what you think and what you see and how you feel can trick you. The market is vast voting machine, and I could give you a handful of reasons why home builders have held up, even though I think the volume of sales seems really light. I have a family member trying to sell a house, and in my neighborhood, I just don't see anything going off. But it is what it is. Best group. Computer software education, gold, silver, we looked at that, hardware, leisure travel, internet content, medical products, computer software specialty enterprises. Last week was 29, this is 9, so that'd be interesting to review. Again, the industry groups haven't done a great story of telling you where, kind of where the fishing pond to look for leadership is. It hasn't been so easy in the last handful of months. Okay, so I think that's it for the industry groups. Let's go to stocks to watch. Let me make sure I'm sharing. Okay, so let's start with the big boys. So Apple had a great day today, and the earnings report was pedestrian at best, but this is all that really matters. In fact, it's kind of telling you something if it can go up on not that great a report. The report was, I didn't dig into the weeds, but maybe it was better than they expected. And so you can see that, look, this is a big stock of 4.5% on a really very pedestrian earnings report. It's at or near new highs. I don't know what to make of it. I don't own Apple. I'm not short Apple. I think it's a non-event, but I've been sort of wrong on Apple, honestly, because I felt like that it would go sideways to down versus sideways to up. This is, I think I did the math. That's a 40% move in a couple dozen weeks. So it's really held on really well. Microsoft, same thing. NVIDIA really is probably the best in breed. Look at how well that's held up. Look at all the blue weeks. Now you do have earnings in maybe 3 weeks, 19 days here. And I would be shocked if those earnings aren't great, but that doesn't mean the stock goes up. It could be they're really building that into the price. And even Tesla, which got real quiet in here. See how you like this little fake breakdown right there out of this, and boom, boom up, and then really quiet. So even Tesla, to me, I wouldn't go long it, but I don't want to be short it. I just think that it probably needs some time. So I'll revisit it later. Google, I don't know. I don't know why Google's such a laggard, but it is. It is what it is. So that's kind of the big caps. ASML looks like it's setting up. So you're building this cup with handle, and you've got, accelerating earnings and sales. No, accelerating sales for sure, but not the earnings aren't accelerating. But yeah, they are. Minus 15, minus 1 is better, right? Plus 180. This looks very interesting to me. I do own ASML. I like this company. I just like where they're at. I mean, look, the fundamentals, the return on equity, 56%, earnings growth rate, 28%, 95, 99. Fund ownership is actually increasing. To me, it's best in breed. And if, you've got this new friendshoring or whatever you want to call it, where they're just going to start building these chip factories everywhere closer to home, so to speak, whether it's US or whether you're another country. And ASML they're the ones. So I really like this company. Now, that doesn't mean the stock has to go up, but I like this kind of action. Sort of strong, powerful move, pull back, pretty good move, pull back, okay move, smaller pullback. You see how it's really getting tighter, and it reminds me of the market after the 09 crisis. And let me make sure I have this. I'm going to go to the NASDAQ because the NASDAQ will be a little bit more volatile and more. And so I probably went too far. I don't really want to capture this. So you get this really bad break. And then you get a number of weeks up in a row and then a little pullback. And you see how it just kind of stair steps higher. Now, this is an index versus ASML as a stock, but it just gets tighter and tighter. And it's not making a lot of progress, but the basically what it's telling you is this kind of downdraft is over. So I think ASML went down probably more than in half. What's that? 800 down to 450, roughly in half. And now it's getting really, tight. This is a 16% base. You go to the daily, you've got 16 with 11% handle. So I own a little bit, and I'll add a little bit if it starts to work. If not, then I'll stop myself out, just like all the other bad ones. I don't know if I mentioned these, but here tried to break out and just crushed the next day. So I got stopped on that one. Tidewater never really broke out, crushed here. Oxy is another one that I did own. Bigger, so not as bad of a sell-off. I think I'll just wait for some type of move back above that, possibly. So there are some landmines out there. I apologize, I can't remember who said it, but there's maybe it was David Ryan. I think it was David Ryan on Ivy Live. So there's gold mines and there's landmines, and Weatherford was a landmine. I bought it that day, and I bought more that day, and luckily I didn't buy more in the breakout because I'm wary of that. And you can see how it peaked its head above the breakout and closed pretty poorly. I wish I'd sold that, but the next day it was like every tick was down, and they got me. Lilly actually looks really good. They had good news on an Alzheimer's drug, and they have the insulin/obesity drug that's become very popular. That allegedly Kim Kardashian, I don't know if she used the Eli Lilly one or the Novo Nordisk one, or if she even used that, but I guess the rumor was that she did. And I read that there's such huge demand for this drug they have that they can't make enough of it, and they can't people who really need it versus people who are just trying to use it to lose weight, trying to save it for those people. Very interesting to me that in the addressable market for something like that, unfortunately, is huge. But you've got quarterly earnings and sales increasing, right? 2/19/38, 8/18/24. Now, it's not in a great spot. Unfortunately, I was kind of asleep at the wheel on it. I should have been more proactive down there because that kind of story was out there already. But it gapped down on the earnings, and then it didn't keep going down. So if you look at a weekly, but 46% closing range, still above the 10-week. If you're looking for something more big and liquid, you have something like that. And then Suave. Now there is a rumor of a buyout, and you do have earnings in a few days. So this is the problem with this stock. So I do not own this one, but it's definitely on my radar. ON is everybody's favorite, and makes sense why. It did give back a little bit of the gains today, but just kind of stair-stepping higher. That's been a pretty good one. And I'm trying to think of what else was out there that's holding up. So there just isn't a lot. I don't have a ton of watch list candidates, unfortunately. So I think we're stuck in the middle. I think it's a market that's, I don't know, maybe it does go higher, but it's just not easy, that's for sure. All right, let's get into the quote of the week. I think I have two because they're so similar. All right, so I did tweet about Stan Druckenmiller's interview with Norwegian bank, maybe. And look, somebody tweeted, "Oh, there's nothing there. I don't, what did he say? He made a very fair tweet response about how you can't trade off of his ideas. Agreed. I'm not looking to trade. He said he's short the dollar. I'm not shorting the dollar. Anytime I listen to these guys, I just want to hear how they think, how they approach risk, how they approach reward, how they manage themselves, their emotions, how they manage their money. I'm not looking for a handout. There's plenty of ideas out there. And I think you always handle your own ideas much better. I'm not a big fan of getting ideas from people, as my friends will know. I don't want, I'm very, very reluctant for them to tell me, oh, I like XYZ or ABC, because I just don't know if I'm going to handle it correctly. So I like to find my own ideas, because if it's mine, I handle it better. I know where I'm wrong, and I know if I have conviction to hold on to it. If I take somebody else's idea, am I going to get out when they say get out? I'm going to wait for them to get out. I'm going to find out 5 days later that they're already out and I'm still in. It's just much more difficult. So I think the interview, and it's very short, 15 minutes maybe, is very valuable. If I get an idea, I think it's attractive for whatever reason, I generally go ahead and buy it. I don't like to wait around. I tend to do this. I've talked about this a million times. Just shoot first, ask questions later. George Soros would say, invest first, investigate later. Stan says, I'm not that smart. We'll cut the analysis short. I'm in that camp. I know what I don't know. And you could spend hours on YouTube and analyst reports and doing all of that. And in the end, if you have a plan to get out if you're wrong, that's pretty much all you need. Now, if it starts to go your way and you want to maybe hold it a little bit better, then I think you can dig into the weeds a little bit and see, like, why could this go a long way? Is there anything there that could possibly help me to hold it, that it could be a bigger move? But I don't like to do all of that initially, because then I can become wedded to it and reluctant, like Weatherford. Maybe, I buy it and 3 days later I got to get out. Or if you bought the pivot, you're supposed to get out 1 day later, and you can freeze because you just spent all weekend watching YouTube videos on Weatherford and why the oil and gas machinery equipment stocks are going to the moon. So I don't do any of that. Now, if I get ahead 10, 12, 15%, I might do that. I might say, hey, what's the reason I might want to hold this much longer? Invest and then investigate. Luckily, I don't have clients, is what he says, which is, if you're running your own money, you don't have to answer to anyone, right? So if I buy something and 90 seconds later, I change my mind, I'm going to get out. It's not something that I'm trying to do to hold it for 90 seconds. And I'm using an extreme scenario, but I don't care. If I buy it, and something doesn't feel right, I tend to go with my instinct and get out. Like Tesla, for the last few days, I haven't been, something about Tesla bothered me. It was just getting too tight, too quiet, and it wasn't going down when the market was going down. And I should have been much quicker. I cut the position, but I should have just got out of the position. Today it was up, I don't know, 4% or something. So I just if it's not right, I just move on. I can always revisit it. And I don't have any clients. I've got, myself and my wife, I guess, but she's not watching. She's not looking at every trade that I do, luckily. So if you don't have any clients, just managing your own money, you have tremendous freedom to do what you think is right. That doesn't mean you're going to be right all the time. It just means you can act accordingly. If you want in, you can get in. If you want out, you can get out. And it's believe me, I know there's a lot of people out there that wish they had that freedom, professionals that wish they had that freedom. I know there in 2000, the couple of the portfolio managers used to tell horror stories. They were on the institutional desk and they would talk to mutual fund managers, Fidelity or T. Rowe Price or whatever. And they would advise them on stocks, and the O'Neill companies, they were out of it. They were long gone. And one guy told the story of a portfolio manager. She was practically, or was in tears with the stocks she was in and how far they were going down, and she couldn't do anything about it because she had to stay invested. And a lot of them, she just had too much size and couldn't move the position out. And so it's a big advantage to have that freedom to go ahead and move if you feel like you need to. I listened to, and it might be an old interview, but I listened to Charles Harris's interview again. And he said, a lot of people have a tendency to hesitate and wait, but you always feel better when it looks more obvious, right? So when it looks obvious, it feels good, it feels right, and therefore it's probably incorrect. Like shorting banks 2, 3, 4 days ago. It feels right. They're going down, shorting KRE, and everybody's shorted, and that's when it's too late. You're adding risk to the trade when you do that, when you hesitate. So I really love that from Charles. So Stan Druckenmiller says, I don't like to wait around. I generally go ahead and buy it. I don't like to wait around. And Charles says, tendency to hesitate and wait. He doesn't. He just puts his position on. And, maybe you can reduce your size. Often that's how I'll do it. If I buy something, it's a reduced position size. It's a probe. It's a starting position. And if it starts to go my way, then I will add to it, but within reason, a certain percentage, a certain number of days. I'm not going to, if I'm up 12, 15, 20%, I'm not going to add to the position at that point. All right, guys, have a great weekend. Marcus Smith at investors.com, 800-424-9033. Thank you, everyone. Bye-bye.